Welcome back. You're watching The Money Show with me, Kavita Thapliyal. And when it comes to investing, many investors prefer to invest in stocks instead of investing via mutual funds. Now, when you are investing in stocks, you must get the fundamentals of a company right. And this would mean doing a thorough research about companies and the risk and rewards on offers. So, how should an ordinary investor pick stocks? What are the criteria that you must analyze before buying a company? And let's answer all of these questions with Sanjiv Bhasin, Director, IIFL Securities. Sanjiv, hi, good evening, and welcome to the show. Today, we're going to talk about investing in stocks. So, before we establish the ground for that, I want you to help our viewers in understanding what is the difference between a trader and an investor.
Yeah, good evening, Kavita. Good evening to you, to all the viewers of ET Now. So there is a thin line between a trader and an investor. The trader trades the price and the investor buys a business. The trader sells weakness and buys strength. He looks for an opportunity to trade for a few points or a few rupees or a few, percentages. Whereas the investor is putting in his hard-earned money on a spare capital into a business which he understands will generate returns over a period of time. So the thin line is the trader never becomes the investor and the investor never becomes the trader. To correlate that, if you try to trade in Infosys 10 years back, you missed the opportunity of creating the biggest wealth creator. And if you try to invest in a stock like Arcom 20 years back and you got stuck in the investment as a trader and you didn't book your loss, then you happen to own the worst stock which has been in the last 20 years. So never mix your emotions. The trader trades the price, whereas the investor buys the business or an investment which he holds for a long number of years.
All right. So, can we also say that every market movement or market scenario can be a trader's market, but not every market can be an investor's market, or it's just the other way around?
So it depends on your attitude. If you're a trader, then 9:15 to 3:30 is your playground. You can enter, exit, whatever your style of trading is, whether you're a short-term trader, intraday trader, or long-term. And Kavita, there are three simple rules for the trader to follow. First is value at risk. What is the amount of value which you have at risk? Because suppose you trade the derivatives, one lot is worth something like 7 to 10 lakhs. Now on that 10 lakh rupees, there is a margin of say 25%. So on 2.5 lakh rupees, you are taking an exposure of 10 lakh. The profit and loss will be on that 10 lakh, whereas your amount is just 1/4 of that. So value at risk is very important. Second is mark to market. Every day in the derivatives, there is a settlement. So you should not be trading in a position which is loss making and where you have to cough off enough mark to market, which can again put you in peril of being over leveraged. Second is mark to market. And third is, what is your hedge? What are you hedged against? Because every day there is volatility in the market. One is the local scenario. Second is if you carry an overnight position, there is global scenarios against which you don't have if you don't have a hedge, meaning if you have not counterbalanced your risk, then again you are in a wrong position. So these three things are very, very key for a trader. For the investor, it is the scenario of trying to own an asset class. We own four asset classes. Everyone owns a roof over his head, which is real estate. Fixed income, which manages to beat inflation and generate risk-free return. Third is gold and silver, to which we attribute to the lady of the house. And fourth is stocks. Now, do you own equity as an investment, as a portfolio? And that is an asset class which must be in every portfolio. That is why you are seeing the advent of the retail investor. So all the four proportions are for the business, are for the investor, and in what age is his risk profile, he will have exposure to equity. But equity as an investment is a must, because that is how your capital will grow from small amounts into wealth creation.
Very well explained, Sanjeev. But then let's focus on the investor part of it. How do you read the market currently for an investor? And in general also, are we closer to the new high, or you think there is, now the market is getting exhausted?
So Kavita, new highs are for the manuals. it's not material whether you saw, how many years, it's 2.5 years when you saw the COVID lows of less than 8,000 and you are back to 18,800. Last year again, or 3 months back, we were at 16,800. So the idea is that you have to be in the market. There is no such thing called timing the market for the investor. The market has to, the investor has to spend time in the market. I think new high is a formality. It may happen in this week or next week. It's just 300 points. It depends how your portfolio is positioned and how much money are you making on new highs. Are you still stuck with some stocks which are far from their highs or are not beating the index? Then you need some guidance or you need some sort of a rebalancing of portfolio. We think new highs are inevitable, Kavita, even though the market in the short run is definitely overbought. But the macros for India are putting our demographic premium in the best place I have seen in last 33 years. And I think that may continue for the next 20 years. However, there will be the bouts of volatility where markets will see corrections, which is healthy for the short-term players.
Let's talk about picking specific companies now. Looking at the current valuation, what are the specific sectors that you're looking at? And also within those sectors, if one has to pick up a company, what is that fundamental homework that you need to do?
So, Kavita, on sectors, you've seen that banks and autos on numbers are outperforming. Banks because of the sheer, credit expansion which is taking place and the cleansing of balance sheet. The numbers, the NIMs, the net asset returns have been extremely good, and we are seeing credit expand, whether retail or capex on the corporate side. So banks are in a very sweet spot. Plus, inflation has been benign, and the RBI has been on hold in the recent rate high policy. Second is autos, which have come back after a 3-year hiatus, and all because that the demand for autos is at a new high, which I have not seen in 10 years, which means that the supply chain disruption, which was an irritant, is starting to ease, and companies are laughing their way to the bank. Third would be input costs like cement and cement clearly, because I think once we are through the monsoon, they will be able to raise prices, and you've seen housing and the ancillaries do extremely well. So these are three very, very strong sectors. And if you have some allocations there, you are doing well. But we think select stocks like select mid caps is where the real money is, because mid cap index is hitting new highs on a daily basis before the index has done that.
Valuations are still attractive in the mid cap and small cap space, Sanjiv?
Yes. So Kavita, you have to have your asset allocation correct. Now, like you asked me, how do you choose or what do you do? Firstly, you have to see the market cap of what you buy. The market cap is the best guide of where your risk reward is. As Warren Buffett said, he said, there is a price for everything. And when the price is in my favor, then you go whole hog in what you want to invest in. Now, in some of the mid caps, we've seen that a lot of the price erosion or the price performance was more to do with greed and fear. And we think that mid caps are offering a very, very good entry point. Plus, you are playing against the large cap index, which trades at a very high multiple in the sense in the emerging market basket, and which seems fairly priced or fairly expensive. So mid caps offer you that value, and that is why you have to go deeper into what you buy, as in the market cap, the promoters, the peer group, the debt, how the cash is utilized, and last but not least, how the peer groups are performing. And in that, you select your basket of stocks which you think have a potential to become from mid to slightly larger and large caps over the next few years.
Sanjiv, just like how we plan our entry in the market, although one should not time the market, but if we leave the entry part aside, how can we time the exit in a particular stock, and how important it is?
Yeah, that's a very good point. Now that again depends on your horizon, your risk profile, and your return, expectations. So, Kavita, the first thing I must tell investors is trust your mutual fund or trust your relationship manager. I am in a broking firm, so obviously this is our job. Whether it is depending on the amount of corpus you have, whether it is direct investment, investment through equity mutual funds, through PMS, through AIF, there is a whole basket of investments. Now you have to plan your investments in how you want to generate returns, and what is your goal. If you have a goal, only then will you be able to achieve your desired objectives. After being in the market for 33, 34 years, I realized the first thing you start off is, because capital is limited, you try and generate a return in your mind which gives you a certain amount of uh, what you expect. Once you generate that return, what I started to do was, since my capital was limited, I took out my capital, but I let the profit remain in the shape of those stocks as an investment. And some of those actually worked wonders, and those investments grew. So to each person is dependent his own style of investing, his expected returns, and when he wants to take home the profit. But periodically, if you are not there for the next 5, 10, 15 years, which is an easy way to say, then when you see that the market is looking frothy, it is always advisable to take home some cash and wait for another rainy day when again you can deploy that.
All right, when we talk about investments, we really try not to strategize our portfolio strategies or our portfolio calls based on near-term events. But then, since you are there with us, I want to understand your take on the RBI policy on the 8th, and also next week the Fed policy. What do you think can be the call taken? The rate pause will be extended, and looking at the global triggers now, how strong are we on our grounds?
So, Kavita, firstly, let me put it on record. Unfortunately or fortunately, the Fed lost credibility. In 21, when inflation was starting to rise, he termed it as being transitory and misread the markets. And then you came all guns blazing when inflation hit sky high at 9.5%, and you raised rates from 0.5 to 5% in the space of 8 months. Then you had your casualties, the SVB Bank, the First Republic Bank, in Europe, Credit Suisse. So all these are short-term measures which created panic as far as the currency, and some of the leveraged banks which misread the market on the interest rate scenarios in the short and the medium term. However, we think inflation is benign, and even in the US now inflation is closer to 4.5%, which means that the Fed this time should be on hold, because I think he's run way ahead of the times and realizes that even though there is a mild recession, you run the risk of some other banks having exposure to a time duration mismatch in asset liabilities. I think the Fed is on hold. On RBI, I definitely think it's a hold, because we've had a benign inflation environment. Secondly, Kavita, crude is not 100, it's not even budging past 70, 75, which means inflationary pressures are going to be much more benign in India. Our capex is doing well, and bond yields are very, very stable. On the global side, I think most people had predicted Europe to be the elephant in the room. Unfortunately, that didn't happen. They have run into a mild recession, but stock markets being forward-looking barometers, all European indices are hitting all-time highs. So, like I said, don't try and time the markets, because markets are smarter than all of us put together. We think that the policy rates are going to be benign, and that could actually trigger some sort of short covering stroke under ownership of stocks as bond yields start to fall.
Otherwise, it's a comfortable scenario for the Indian market. And with that, thank you so much, Sanjiv, for being on the show and helping our viewers. In fact, giving them the checklist of being a smart investor. Thank you so much.